Good evening, I'm Shua Mar. StatCan's the daily released Canada's balance of international payments for the second quarter of this year, and the headline figure is stark. Canada's current account deficit widened by $19.8 billion in the second quarter of this year, reaching an unprecedented $21.2 billion on a seasonally adjusted basis. This is officially the highest current account deficit ever on record, surpassing the previous high set in the third quarter of 2010. The main culprit behind this record deficit is the rapid widening of the trade and goods deficit. The overall trade and goods and service deficit swelled from just $0.8 billion in the first quarter of this year to $19.5 billion in the second. The trade and goods deficit itself reached a record high of $19.6 billion, driven by the fact that exports declined much more sharply than imports. Canadian goods exports fell by a staggering 13.1% to $182.2 billion. And this is not just a modest slowdown, it's the largest quarterly decline in export value on record. It's pushing export values to their lowest point since the fourth quarter of 2021. This widespread decline was largely concentrated in three critical sectors: energy products, which fell 20.5%, motor vehicles and parts down 16.6%, and consumer goods also down 16.6%. Now, these cratering exports coincided with two major external pressures: the implementation of U.S. tariffs on Canadian goods and a sharp appreciation of the Canadian dollar compared with the U.S. And the impact was immediate. The goods trade surplus Canada holds with the United States narrowed severely, falling from $31.3 billion in the first quarter to just $10.1 billion in the second quarter. Now, while exports collapsed, imports of goods also fell, decreasing 4% to $201.8 billion. Key import declines were seen in motor vehicles and parts, consumer goods, and energy products. However, in a rare positive note, the trade and service balance moved from a small deficit in the first quarter to a $0.1 billion surplus in the second quarter. Now, that shift was due to the commercial services surplus increasing significantly, rising from $0.4 billion to $1.4 billion, largely led by increased exports in maintenance and repairs, computer services, and financial services. However, the trouble deepened on the financial account side, reflecting a clear loss of investor appetite for Canadian assets. Foreign portfolio investors reduced their exposure to Canadian securities by $16.8 billion in the second quarter. Now, this massive reduction represents the largest foreign divestment in Canadian securities since the fourth quarter of 2007. Foreign capital fled across the board, with investors selling Canadian bonds, money market instruments, and equity shares. At the same time, Canadian investors were also looking abroad. They were acquiring about $26.8 billion of foreign securities, primarily foreign equity securities, and largely U.S. shares. Add these flows together, and the result is a massive net outflow of funds of approximately $43.7 billion from the Canadian economy due to portfolio investments alone. This was the second consecutive quarter of sizable net outflows. The country had to finance its record current account deficit somehow. The required inflows of funds came primarily from transactions in the form of currency and deposits. Direct investment offered a small measure of stability. Canadian direct investment abroad reached $26.8 billion, driven mainly by earnings reinvested by Canadian companies in their foreign affiliates and merger activity. Meanwhile, foreign direct investment in Canada totaled $18.5 billion. So in conclusion, the combination of the largest quarterly export decline on record and the largest foreign divestment since 2007 places Canada's external accounts under severe pressure. We're all going to be awaiting the data on the third quarter of 2025, which is scheduled for release on November 27th. I'm Shua Mar, and thanks for watching.